So my charge today is to talk about financials. So the easy old school way is you get a manila envelope and you write on it January 2017, another one February 2017, and so on, right? And you put a line right down the middle of it, and on one side you write income or sales, and on the other side of the line it's expenses, right? And so you're just keeping track of what you're taking in and what you're taking out. And the fact that it's an envelope, you can put, if you have sales receipts, put them in there. It works, okay? It's not high tech, it's not hard, but it works. And then you'll have what you need when you get to the end of the year and you need to go to your tax guy. And we all know that nowadays, if you carry your 12 little monthly envelopes to the CPA to do your taxes, you're gonna pay a boatload of money. He doesn't want it, she doesn't want it. They want you to have figured it out, put it in a spreadsheet or something else. They'll do it, some of them will do it, some of them will not even see you. That certainly beats throwing the receipts up on the dashboard and then the wind blows and whoa, it went out the window and you're never gonna get it again, right? But a lot of places now, they'll give you an electronic receipt, and those of you who are familiar, maybe use Dropbox or some other method like that. You can just save it in your Dropbox file, and you can have a file that says January 2017, February 2017. You just drop them in the one they belong in. Or you can take a picture with your phone and drop it into your Dropbox file or some other file where you're gonna keep it. It works. So that's my quick answer. How should you do it? Do the one that you're gonna do regularly. That's all. There's a lot of in-between methods that people have. Some people keep spreadsheets and all that stuff, but you still need the source document. So you gotta figure out how to keep the source document, keep it where you're gonna find it when you need it, right? And then all the talk about what kind of program am I gonna use, you know, because probably the one that's used the most is QuickBooks. Heard somebody say they use Quicken. Quicken works. If you're not having to invoice people, Quicken is like for your home. You can use your home, bookkeeping on it. So you can use that for a farm as long as you don't have to create an invoice or something like that. It won't do that for you. There's some features it won't have, but by and large, it works, right? But you're gonna have a better time finding someone who's gonna support QuickBooks because it's just used more often, right? You are to have a dedicated bank account and not be commingling your private stuff with your business stuff. That's one of the requirements of that veil of separation between you, the individual, and the company, the LLC or the corporation. So yes, you need to do that or you're actually piercing the veil, whether you get busted at it or not, but you just don't want to do that. It's easier, like the gentleman said, to have a credit card for the business and a bank account for the business, actually, or at least a credit card for the business.
Any advice for, given we're agriculture and oftentimes family agriculture at this point, how do you start managing the benefits, tax ramifications, tax benefits at the time of filing?
I'm not going to give you any tax advice, okay? I've done taxes, but I'm not a CPA. So I think at that point, it is time to talk to, the person doing your taxes that would give you that counsel. So like Nancy said, we have some CPAs that, on a list that if you don't know where to go, we can give you a list of names. We're not trying to shovel anybody business, but we recognize that's a need that people have, is to find someone that can help them. The CPA is the tax advisor, and that's part of being a certified public accountant, is that they can give you tax advice and they can represent you to the IRS. Well, you absolutely are always going to be responsible for that because they're not going to know whether that receipt in all your manila folders are just your personal crap thrown in there because they're not looking at it. They're not going to detail through it. So that's what that refers to. But as far as if you did get audited, you're going to pay them, but they're going to go represent, they're going to help you when you're represented.
Biggest deduction that I haven't actually heard, one of your biggest deductions? is mileage.
Thank you. That's a very important point. A little spiral notebook in your car. It doesn't have to be a mileage log that you bought at Office Max or whatever, but that has the date, the purpose of it, and how many miles it was. Those are the three critical things you need that show that it was business related. And yes, at last I knew it was 55 cents a mile, the deduction for it. So it's really critical. It adds up very quickly. You definitely want to have it. And it is a very highly deductible or audited part of a return. So thank you for making that point. The other side of that, there are apps that will keep track of your mileage too.
The USDA also has the reimbursement transportation cost program. So if you keep your gas receipts, you can also get a little bit of it back. Because I think Hawaii is one of the few states that have that program.
But you have to have receipts?
You have to have the gas receipts.
Okay.
And it doesn't matter if it's all for business or for your personal too, but you just keep your receipts and then they'll work with you. They're really nice and knowledgeable.
Thank you. I did not know. Thank you very much. Before we can do the financial on a new type business, we have to say, I have 10 acres of either leased or owned property on which I'm going to grow X number of crops that will need to be planted in whatever year and will be harvested in, and sometimes it's March of 2016 will be harvested in September 2016. You would modify that. And then how much you expect you're going to make in that year with the total cost of X and a profit of X. In 2012, there were 1,600 trees planted, and those were the Noble Douglas and Grand Firs on 2 acres at 6,500 foot elevation, expecting that 3 to 5 year harvest. And then in 2016, they worked with a number of you, I guess, in this room, and planted 600 more Douglas fir seedlings. For any of you who are considering this Christmas tree farming, there's an excellent report. It's SMS did it for DLNR. So it's on the DLNR website, and it's really valuable. And it talks about how in Hawaii they know there's 190,000 Christmas trees purchased. And only 7,500 of those trees are grown in Hawaii. So that's roughly 183,000 trees that people are importing and purchasing from the mainland. So that tells you there's a market niche, right? Now we know too from reading that report especially that what people really love is they like those smelly trees, and those trees that they planted were the ones that people buy the most. Those are not the easy trees to grow here in Hawaii, we know that. And the ones that we grow more easily are not the fragrant trees. So right away, we're marketing something that people don't at first want. So as Nancy said this morning, then we have to market what we do have. Okay, that's our downside, but they are what? Locally grown. And almost anything we grow in Hawaii, we market it because it's locally grown, and we want to support each other, and we want to support our local agriculture, and we want to support our local economy, and that's the thing we got to keep ringing that bell, right? Ringing that bell, and you got to market it all the way through. And also to point out that you want to go read that report. It's a really valuable report. So you might have 10 acres, you're going to plant maybe just 1,000 Christmas trees right now, 2016. Ready to harvest in 2021, for instance, 300 trees, and you're thinking you're going to sell them at $50 each, that might net you $10,000. Then the same formula, but a different plan might be that you're going to plant 1,000 trees, but you're going to retail your trees. So you might sell them at $110, and it says a pound, excuse my editing error there, it should be per tree. And you end up with a much higher expenses, but also a higher profit. Okay, so the point is This is why you must work through your plan. How many of you have had a business idea before that you didn't execute, you didn't do it, but then somebody else did it, maybe 2 years later, 3 years later? Anybody had that happen? Probably most of us have had that happen, right? My point is that there's a big difference between a business idea and a business model, like actually working out how will these numbers flow? How am I going to distribute my product? How much time are we going to invest to make this product? So idea, business model, down to business plan, which is really nuts and bolts. By the time you write a business plan, you're going to say, I will be planting 1,000 trees in 2016. With the plan that I will harvest, ... So you have to figure out, of course, what's appropriate for you, and then it creates a very different plan. So that's kind of our point. How you're going to market, how you're going to advertise, what will my costs be, will I sell directly or will I sell online? How will I transport them? How will we ship them? Kind of what are those costs and such, right? And every business plan must have a financial plan with it. So key financial reports, the income statement, the balance sheet, and a cash flow projection. Let's start with just a sample income statement. So it's really important to know what your sales number is, and then those direct costs. The direct costs are those ones that vary directly by how much sales you had. And then gross profit, that's one of those numbers that by industry, we can go out and research and find out, am I in the ballpark? Am I where I'm supposed to be? So you do have to know you want to know your gross profit. And then all those other expenses, which we usually call operating expenses. So it's all the expenses of selling, insurance and all that kind of stuff, and down to the net income, which is another, varies a lot by industry, even by type of farming. So you want to keep track of these things. We want to do it in a way that you do it consistently so you can get frequent financial reports. 12 months without knowing where you're at financially is it's not a good idea. It's just not a good idea, right? So we got to figure out a way to make the collection of those things quick. You could take your manila folders and you could add them up. You know, that works. You don't have to wait till the end of the year. You could go into whatever app or program you're using and you can pull a report. It's possible, and it's really not as difficult as it seems. Then the second report is the balance sheet. But this one just tells how much you own and how much you owe. The balance sheet is how much you owe on the asset side, and then how much you own and how much you owe. So an income statement tells us how much sales and how much came in, and then we break it out into those direct costs or kind of operating costs. But the cash flow projects how much cash you're going to have. And as you can see, it goes month by month. So the cash flow projection, that one shows you cash, how much you're actually getting in and how much you're actually paying out, so that you don't run out of cash. We always hear the bad stories about farmers and businesses that fail, right? More often than not, it's because they ran out of cash. And so that's why we have that separate report. So our cash flow projection shows us the cash. Make sure we keep enough cash on hand to hit the low time before we get paid for the harvest, right? Whereas the income statement just shows us, how much was paid out. So really, to know that, you have to put together that income statement and that balance sheet. Because if you're going and running up your credit card, that's on the balance sheet, but that's not on the income statement. So you're kind of robbing Peter to pay Paul, robbing your own bank account to pay the farm. So it lists all those flows in and the flows out. And it shows the timing. So you're projecting like, oh, my lychee crop will come in this month, but then I have to wait 30 days to get the money. And so you can plot that out. Okay, when we're talking cash flow projection, we're talking about money coming in, right? So we get money by selling product, by receiving money on a loan, or we might get money, somebody lends us money. So that might be ways we get money in, but they aren't all showing on that income statement, right? And then money going out, of course, to pay expenses for the farm, to purchase equipment. That equipment doesn't go on the income statement. It goes on what now you own. So it's on the balance sheet, right? If you have to make payments on a loan, that's on the cash flow projection. Or if you have to pay out earnings to other owners or even to yourself. That's part of that own and owe part, but not on income. But it is all brought together in this cash flow projection. What I want you to take away from this right now is that you need to devise a way to keep track of your income and your expenses. Okay, and then I want you to know about those 3 financial statements: the income statement, the balance sheet, and the cash flow projection. Thank you.